Hello, everyone. Welcome back to another episode of Signal or Noise. This is episode 73. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, getting a lot of questions lately on one topic. That topic is IPOs. So today's discussion is going to be about how to think about investing in IPOs. And you and I are going to run through 4 questions here that I put together that I think is going to be helpful for a lot of people in terms of how to frame all of this. There's a lot of euphoria right now in terms of the IPOs that are going to come out in the next few months, and we'll run through that. But I want to answer or try to answer these 4 questions. Why are companies staying private longer? Where are we in the IPO cycle? Do most IPOs live up to the hype in terms of their performance once they come public? And we'll end with how should investors think about portfolio allocations to IPOs. Okay, let's begin with why are companies staying private longer? You and I touched on this a few years ago. I want to do an update here, but here are 5 reasons that I put together. You could tell me which of these you think is most important, but private capital obviously is abundant. You don't need to borrow in public markets. You can borrow in private markets very easily, right? It's becoming a very big growth market, private credit. Avoiding public market scrutiny, right? You can focus on the long term. There's less quarterly earnings pressure. Founders can maintain their control for longer. There's huge regulatory and compliance costs when you go public. And lastly, employees and investors can get that liquidity now in the private market through secondary sales or private share sales. These are 5 of the biggest reasons. Which ones do you think are most important here in terms of why companies are staying private for longer?
I think, Charlie, basically what's happened is if you wanted to raise money, if you wanted to exit your company, you had to go public. You didn't have other choices. Well, now there's private equity, and they're perfectly willing to invest in a minority or a majority of your business. You can get the liquidity without going public and dealing without the costs and regulations and all the liability that comes with it. If you want to borrow money, that used to be a reason to go public. Hey, I'll take my company public, I'll issue bonds, borrow money. Well, now there's private credit, happy to fill that void. And that's why I think one of the many reasons you've seen there go from being over 8,000 publicly traded companies to just over 4,000. They're just not the same incentives to IPO that there used to be.
Do you think that Congress should pass some type of legislation to make it a better environment for companies to go? So they can't control all of these things, but they definitely can control the regulatory part of it. Do you think that should be a focus?
I think if they control the regulatory part a bit, like lay off the quarterly earnings, which isn't good for investors anyway, companies should be using longer time horizons. I think some of it will get better, but in general, no matter what Congress does, now that the key reasons to go public are not as relevant, I think you'll just never see the rush to go public that we saw for most of our lifetimes. I think we can make it a little bit better with regulation changes, but the landscape has fundamentally gone private.
Yeah, I just want to give an example here and just show you what that has translated into in terms of public market companies here. 8,000 was the peak, Peter, back in 1996. We're at less than half of that today, around 4,000 public companies. And you and I have talked about this is a pretty good reason for investors to consider investing in the private markets just because you have so many more big private market companies. And if you're just investing in the public markets, you're missing that extra element of a diversification. But I want to talk about Amazon versus SpaceX and just give you the contrast here because it's pretty stunning. Amazon was founded in 1994. It goes public 3 years later in 1997. Its market cap back then, Peter, 442 million. It seems crazy by today's standards, what we're going to be talking about in a little bit. So Amazon's market cap, Peter, since that IPO in June 1997, up 6,484x. It's now close to a $3 trillion company. And let's fast forward to today. We have SpaceX, which we're going to be talking a little bit more about here, but $1.5 trillion is its current valuation and expected to go public at around 1.75 to 2 trillion in terms of its valuation. SpaceX was founded, Peter, in 2002. So we're talking about 24 years later, and now it's finally going public. What's the implication here for investors?
Why that we've just never seen an IPO like this. I mean, there wasn't a $1 trillion company until a little while ago. Now, I don't know, there might be 6, 7 of them, many of them in the Mag 7. But to have a company go public, not just over a trillion, but like way, way beyond $1 trillion, we've never, ever seen anything like this. It's going to be really fascinating. We might see it multiple times. We might see Anthropic and OpenAI follow also with $1 trillion market capitalizations. Certainly possible.
Yeah, and I think if you're a private company and you're looking at SpaceX, you definitely wouldn't say that it was held back from staying private longer, given this trajectory here. Just a stunning increase in terms of its market cap over the last decade. Let's go to number two here. Where are we in the IPO cycle? And you and I touched on this last fall when people worried about an AI bubble, and we said the one important thing that's missing from that equation there in terms of is this a bubble is the supply that you usually see, the IPO wave that you usually see at the peak of a market. And that supply, I think, Peter, it's safe to say it's coming. It's coming soon here. If we look at IPO issuance by year, you could see the standout was in 99, 2000, and then back in 2020, 2021. And now we got 48 billion year to date. But this number is going to change dramatically in the next month because of SpaceX. And why are companies all of a sudden thinking about going public, Peter? Well, I think it's just based on markets are very favorable right now. There's a huge risk appetite. It's very favorable now to bring your company public. A few ways to look at that. Tech sector relative to the broad market now higher than the peak in March 2000. If we look at the last 3 years in terms of stock market performance, you got semiconductors up 275%, US tech sector up 135%, S&P up 88%. They're talking about 55% annualized returns for semis, 33% for tech, 23% for the S&P 500. So this is an environment, Peter, that's ripe to see that more supply because they're going to get a good price in terms of that IPO. And this, as you said, we've never seen anything like this. So the previous record in terms of money raised for an IPO was Saudi Aramco back in 2019, raised 26 billion, and SpaceX is expected to raise here, Peter, $80 billion.
Yeah, I mean, like we're talking about just something on a whole different level. And IPOs don't really ebb and flow; they come and go. Like just like you said, if the market's hot, everyone wants to go public in that window and get everything done as quickly as they can. I think we're going to see as many companies go public as possible as long as this bull run continues. Because when you get the downtrend, it can go on for years, as we saw with 9/11, the tech bubble, 08, 09. A lot of companies are looking at this and going, look, the market's hot, it's receptive, risk appetite is on. If we don't take advantage of it now, we could be on the sideline for months or for quarters or for years. And so I expect the activity to pick up, especially with these bigger ones.
Absolutely. And just to put it in context here, I thought this was an interesting chart here. 3.75 trillion is one estimate for SpaceX, OpenAI, and Anthropic put together. Could be even higher than that, some are saying. But as compared to the dot-com era, 1995 to 2000, Peter, even if you adjust it for inflation, that would have been 3 trillion. So just three companies are
Right.
ahead of that enormous wave of IPOs during the tech bubble.
2,600 IPOs not equaling three is just incredible.
For sure. And so, where are we in terms of the IPO cycle? We're at the point where we're going to see a massive increase in supply, and how much of that supply comes is going to be dependent on how favorable the market stays and for how long. Because as we saw in 2021, as soon as 2022 came, Peter, and prices started to go down, all of a sudden, all of the IPO activity dried up. Let's go to number three here. Do most IPOs live up to the hype? And this is going to surprise a lot of people because I think, Peter, there's so much media attention around IPOs, and they like to talk about the share gains, particularly on the first day, or if a stock runs up a lot in the first month. But they never talk about what happens over a few year period. And so I went back, looked at all the different IPO studies, and this is the longest study we have, going back to 1980, comparing IPOs in the first 3 years, how they did versus just the broad U.S. stock market, Peter. 6% annualized return if you just bought the IPO on that first day versus 11.8% for the broad stock market. Why are we seeing this here?
Yeah, I think this surprises a lot of people, but keep in mind why the IPO is happening is insiders are selling, right? So you have a lot of supply being dumped on the market. And when people are enthusiastic, there is demand there. but usually takes a while, which is why 6 months later, 60, 70% plus of the time, you would have been better off just waiting half a year. The hottest IPO of my career was Facebook. I never had so many people call me and ask to participate in an IPO as I did with Facebook. And Facebook was trading considerably lower 6 months later. Since then, unbelievable tear. But 6 months later, you could have bought it less than the IPO.
Yeah, for sure. Many examples like Facebook, and I just want to touch on there's an IPO ETF that came out in 2013 here, and I just want to show what it's done versus the S&P 500. Again, I think this would surprise people. S&P is up 436% since then. The IPO ETF up 176%. So that's a 14% annualized gain for the S&P versus 8% for the IPO ETF. And that's not even talking about risk here, Peter, because of course, IPOs much more volatile, much more likely to have a big drawdown. I'm showing you that on this chart here. They had a drawdown following that 2021, 2020 mania of 69% versus a max drawdown here for the S&P of around 34%. And while the S&P 500, you and I have been talking about all-time highs for 3 years now, that IPO ETF is still below the peak where it was trading back in 2021. So not comparable here in terms of volatility, much more volatile if you're buying a group of IPOs versus the broad market.
Yeah, diversified investor wins here even more than in a normal marketplace stock picking environment.
So lastly here, I want to talk about Snowflake. This was one of the biggest IPOs from the last wave there. And I'm not showing the many examples that went to zero or close to zero. Snowflake, as a public company, if you look at their fundamentals, done absolutely terrific. The increase in revenues has been dramatic. The problem, of course, that was that there was so much hype around the Snowflake IPO that it was trading at over 200 times sales when it went public back in 2020, September of 2020. I'm showing you here what transpired since then. S&P 500 up 139% since Snowflake went public. Snowflake down 30%. So you have to separate really the stock versus the company. They're two different things because the price that you're paying for the stock really, really matters.
Yeah, your entry point in all investments, the entry point is very, very, very critical. It's not enough to say a company's great, a product's great. It's price. It's what's the price? The price matters. Real estate investors know this intuitively, and stock market investors should be aware as well.
So let me put this out to you here, Peter. SpaceX, if it goes public at 1.75 trillion, you're talking about 91 times last year's sales, and I'm comparing it to other companies here, tech companies in the S&P. You got Palantir at 67, Broadcom at 30, Nvidia 21, Google at 11, Apple at 10, Microsoft at 10. S&P overall is at 3.5 times sales. And if we look at net income here, Peter, Google at the top of the list, 160 billion. Nvidia's not far behind, 159 billion. Microsoft and Apple also over 100 billion. SpaceX has actually lost $9 billion over the last year. Now, of course, investors are not expecting that to continue, but it's hard to say that if it comes public at 1.75 trillion, that investors aren't assuming something just dramatic in terms of the expectations about the future of SpaceX in terms of its ability to grow its sales and its net income.
And at the same time, we're going to probably be really close to creating the world's first trillionaire in Elon Musk.
Yep, absolutely. He's going to have multiple companies right contributing to that, and the market is not always right, as we see, but a lot of investors assume that because the market assigns a value, that it means it's right. Only time will tell. NVIDIA would be the best case example to say perhaps SpaceX can grow into this in the future. But as we know, NVIDIA was kind of the one in a million example here. Just as we'll talk about in a little bit, you just have to understand that this thing is not going public at anywhere near the valuation that an Amazon or a Google or an Apple or a Microsoft went public back in the day. The expectations are much, much higher. They could meet those expectations, but they're very, very high today. Just keep that in mind. So let's talk about investors here, Peter. We're getting a lot of questions from clients, from advisors. How should people think about including these IPOs in their portfolio and I put together a few things that investors should keep in mind here. Number one, check your FOMO here. And in terms of your public market investments have been doing pretty good. The S&P the last 10 years up 324%. That's 15.5% per year over the last 10 years. That's way above the historical average of 10% per year. And I think it would surprise a lot of people, Peter, that the exposure that a lot of these public companies increasingly have to companies like SpaceX and Anthropic, if you look at Amazon and Google, what they reported in terms of net income in the first quarter, big markups from gains in those positions. And if you look at NVIDIA, they've assembled a huge portfolio of these different companies. So if you have broad public market exposure, your exposure to these things isn't nothing today. And certainly your exposure to the AI trade only is increasing over time.
Right. I mean, the stock market's doing great, and it's doing better than IPOs. So I think this one's easy. It's easy to check your FOMO if you just zoom out even the slightest bit.
Okay, let's go to number two. This one's a little bit more difficult in terms of sizing positions appropriately, because people are going to get very excited about SpaceX, and they're going to be and OpenAI and Anthropic, which are expected to IPO later in the year, maybe September, October. But if we look at the combined weight of these in terms of what it would represent in the US index. So the US stock market, Peter, is about 75 trillion today, huge number. If you add in SpaceX, OpenAI, and Anthropic to that, we take a total weight, it would be together collectively about 4.8%. That leaves 95%, a little over 95% in all these other stocks. So I guess the question is, if someone's thinking about putting 20, 30, 40% in their portfolio in any one of these stocks, they really need to have a very good reason to do that, because that would be a massive overweight. And we're not even including international stocks here.
Agreed. And I think it's important to keep in mind, if you're a market-based diversified investor, this is winding up in your portfolio disproportionately already. It's going to wind up in your portfolio. You're going to have plenty of exposure. If you think there's a Mag 7 overweight to the index, the S&P 500 index, just wait until these companies enter the fray.
Yeah, so that's the big question in terms of when will they be included, because usually it takes 12 months for the S&P 500 to include these things, and usually it has to be profitable. But it seems like very likely they're considering it right now. They're going to waive that and move that down to 6 months. The NASDAQ is talking about waiting 15 trading days. And if we look at VTI, which is a popular total market ETF from Vanguard, they're saying that it may include it within the first 5 trading days. So to your point there, you will have exposure if you have broad market exposure, maybe not day one, but pretty quickly after that.
Yes, and this will create artificial demand. I mean, it's going to be an interesting price stabilization. We'll see how this plays out.
Yeah, for sure. And number 3 here, I want to end with this, because you can't overstate the importance of setting realistic expectations in terms of, we know the average IPO underperforms by a wide margin. Just understand that. Hopefully SpaceX, OpenAI, and Anthropic go on and become much bigger companies 10 years from now, and we all benefit from that. But that shouldn't be your base case expectation, should it?
No, I think we end where we began, which is IPOs 6 months after their release are trading below the S&P 500 the vast majority of the time. You stay market-based, you're taking less risk and a higher probability of a better return. One of the few combinations where you can say that's the case.
Awesome. Well, if you're thinking about your own portfolio and how IPOs should fit into that, reach out to us today at Creative Planning. Go to creativeplanning.com/Charlie. I'll have a link in the show notes. At Creative Planning, we're in all 50 states, so we likely have a location right near you, and we're abroad as well. Over $700 billion in assets under management and advisement, and we're here to help. So reach out today, creativeplanning.com/Charlie. Great conversation, Peter. Thank you, everyone, for joining us on Signal or Noise. If you're not already subscribed, subscribe on YouTube, Apple, and Spotify. And Peter and I will see you next time on Signal or Noise.